This is Matthew Cratter from Trade University, and today I want to talk a little bit more about the bear market, which is currently here. If you've been following my channel, we've been talking about an impending global financial crisis for the past 2 months. This video was made about 2 months ago. We've also been talking about how I think that Bitcoin is headed to 30,000, and I think we're still on this path. We've been staying away, my subscribers and I have been staying away from momentum stocks, growth stock names, and just avoiding these strategies really since last December. And there's been a strong bear market if you've been in these names. If you've been holding the ARK ETF, for example, it has almost retraced its way all the way back to where it was in early 2020. So these are the names that have been getting hit. Many of them were very overpriced, very high PEs, and they were priced at irrational valuations. Doesn't matter when the Fed's printing, but when the Fed stops printing, these things begin to really matter. But what we're seeing now is we're seeing the bear market come to the indices. So we've had this divergence where growth stocks have been selling off, but the indices were holding in for a while. But now the indices are breaking down. I love this picture of the red candlestick going down so hard that it goes through the laptop into the floor. The basic problem here is that the Fed is really in a bind. Inflation is bad, so they're trying to raise interest rates, shrink the Fed's balance sheet in order to get inflation under control. But this has the unintended consequence of hurting the stock market and eventually even making housing prices fall. And so you end up with many fewer capital gains and or recession. This leads to lower tax revenues. And then unless a government can cut their spending, unless the US government can cut their spending, it's going to need to borrow more money to make up for these low tax revenues. This means more government debt. Recession means lower GDP levels. More government debt means higher debt levels. And so the big problem here is we have the whole economy and basically the global economy is highly, highly leveraged. This is a chart of debt to GDP in the US. And people who say we need to do a Paul Volcker here don't understand that when Paul Volcker did his thing, debt to GDP levels were around 35% in the US. Today, they're closer to 123% and getting worse as if GDP starts to shrink and as the debt levels rise. So this is the real problem. When the economy is this levered, the Fed trying to do anything ends up blowing up the markets. If the Fed tightens, it blows things up. If the Fed starts loosening, we get high inflation and we get out of control asset prices, as we've seen the last 2 years. So it's really almost like an on and off switch, and Fed policy becomes very dangerous and very ineffective when you have high debt to GDP levels. If you're finding this video helpful so far, be sure to hit that subscribe and like buttons. This is a great way of tracking where the federal budget deficits are currently, about $2 trillion. This might be a little bit better because tax revenues were looking up. Tax revenues are obviously a backwards looking indicator. Looking forward, there's not going to be a whole lot of capital gains on housing or stocks paid in the coming months unless we get some sort of V-shaped recovery. So here's another $2 trillion worth of budget deficits that needs to turn in to government debt. And Russia's not going to buy it because we froze their FX reserves. China's not going to buy it because they saw us freeze Russia's FX reserves. And so this really is a problem. The Fed is going to have to eventually monetize this debt. They're going to have to buy this debt, add it to their balance sheet. The problem is right now they're saying they're shrinking their balance sheet instead. And so we're in this real bind. It looks like the Fed is going to go after inflation at the expense of the stock market and stock prices. Are we close to a bottom yet? I don't think so. I don't think real panic has hit yet. If we take a look at the VIX, we can see that during various points, certainly during the great financial crisis of 2008, 2009, and also during the pandemic crisis, we got VIX readings north of 70, 80, even up to 90. We haven't even breached the level of 40 on the VIX. And so I think we're really much closer to the beginning here than we are to the end. It's already having huge consequences for names that are levered to growth stocks like Tiger Global, for example. They were down 15%. This is a large hedge fund, very historically successful, but they're very levered to all these tech stocks. They were down 15% in April, which brought their 2022 year-to-date returns to minus 44%. And this was before all the carnage of the past few days. So they may be getting some liquidations here. There are obviously other institutional investors getting liquidated, along with retail investors getting liquidated. And so there has been forced selling as well. If we look at the high on the QQQs, the high in the NASDAQ 100, it peaked on November 19th of last year. It peaked a closing price. Intraday went a little bit higher, but a closing price of 403.99. So 40% drawdown, which is fairly typical of bear markets, would take us down to 242.39. That's a level that hasn't been seen since June of 2020. We've seen that the ARK ETF has retraced all the way. There's still a long way for these major indices to go down. And we've already had, as we've spoken about, we've had the death cross here, and we've had multiple failures at the 200-day moving average and the 52-day moving average. And now we're sort of plumbing new lows. And this really does depend on the Fed, what happens here. The Fed can reverse this anytime it wants, but it really seems to be more focused on the inflation question right now. The bear markets of 2000 to 2002 and 2007 to 2009, they had the S&P, which is back then was much less levered to tech stocks, but the S&P was down 50% roughly in each of those. The QQQs were down. I think they went down something like 85% during the bursting of the dot-com bubble. So the QQQs, I'm using that 40% number back here. They could certainly go down more than that. It's hard to see what the tolerance is of the general economy, though, if we get that deep of a recession in tech stocks. I'm still waiting for a giant red daily candle or flash crash in Bitcoin. I still think that's coming. I think we're going to see forced liquidations. I don't know who's still a levered long here, but I do think that Bitcoin is this really good barometer, and that we are still going to see 30,000, possibly 25,000 or 20,000 on Bitcoin. So you just want to be mentally prepared for that. As I said, the Fed can stop this mess whenever it wants to, but there's huge political pressure to get inflation under control before the midterm elections in November. This is hard to believe, but the Fed funds futures are still pricing in a 78% probability that we get a 75 basis point hike. So the current target rate is 75 to 100 basis points. This is showing a target rate of 150 to 175, so 75 basis points higher. And this was after the Fed meeting and the Fed minutes, or the Fed press conference, Powell's press conference on Wednesday, in which he said they're not going to do 75 basis points. So here's Fed funds futures doubting that. There's 20%, 21% chance that they hike 50 basis points, and then a much higher percentage chance that they hike 75 basis points. One thing this could be taken into account is maybe the Fed hikes 25 basis points between meetings and then does 50 basis points at the June meeting. This would get us 75 basis points higher without Powell breaking his statement or breaking his promise not to raise rates 75 bips at a meeting. So what are some lessons for a bear market? I've had the privilege or the lack of privilege to live through two of them. Don't try to go short. Going short really is just for the professionals, and even the professionals get blown up doing it. The problem with bear markets is the volatility. So you can get these face-ripping relief rallies, they're called, 20%, even 30% or more, that can just blow you up if you're short, especially if you're using leverage, if you're shorting the market using futures. If you try to buy puts on the market, either on the S&P 500 or the QQQs or individual stocks, when implied volatility is high, and it's already fairly high with the VIX being in the 30s, you can be right, you can be correct and still lose money if you pay too much for implied vol, and the realized vol ends up being much lower. I do talk about this in my options trading courses, but this is one problem. This makes buying and selling puts, it's almost like flying versus driving. There's that third dimension that makes things a little bit difficult. Another thing to remember, if you're holding stocks with large losses, a stock can go down 70%, and a lot of people are confused and think that then it only can go down 30% before it goes to zero. But if you buy a stock that's gone down 70%, it can easily go down 100% from there. It can go to zero, in which case you're not going to lose 30% of your money, you're going to lose 100% of your money. Many individual stocks never get back to their all-time highs. They were either fad stocks or things change, valuations change. The indices, I think, will definitely get back to their all-time highs and go much higher over this decade as the Fed reverses course at some point and starts the printing presses up again. But a lot of individual stocks may never get back to their highs again. So if you're holding to break even, you better understand why you're holding, what the valuation is, and why you have a reasonable chance of getting back to that sort of valuation based on the PE and the earnings associated with it. There's something else to consider with companies that have had large drawdowns in their stocks, individual companies, what Soros calls the principle of reflexivity. When a company's stock goes down a lot, many talented people will leave the company. Maybe they'll retire early. They'll just think that especially in Silicon Valley, the 16-hour days aren't worth it if your stock options are deep out of the money. Company morale will be low. You'll lose a lot of talent. Productivity will fall as everyone's just sitting at work or sitting at home watching their company stock instead of doing real work. And then this ends up, especially bleeding talent, ends up hurting the company even more over time, which can cause an even lower stock price if the company is less successful as the result of a talent exodus. So this is what you might call the doom loop of reflexivity. It works on the upside as well. When your company's doing well, you can hire smarter people and more talent and create a virtuous circle. What we're in now is a vicious circle. And especially a lot of private companies, a lot of the VC portfolios are getting completely annihilated. We haven't seen anything this bad since the dot-com bursting in 99 and 2000. If you own public stocks, if you own crypto, it's very important that you know what you own. Do you really understand it, or did you just buy it because someone else did or told you to? If you own dog coins, if you own NFTs or XRP or VC coins like Solana, Lord help you. This is a really brutal environment. And many cryptos can certainly go down 95% from their highs. If you own VC coins like Solana, I've been warning you about insiders dumping on you, and it looks like that is almost certainly coming true. It's a little bit hard to know what's happening here, but you can bet that these billionaires, they don't care if Solana's down 50% or 75%. If they want liquidity, they will keep selling. If you own Bitcoin, and you should own Bitcoin in my opinion, that's not investment advice, but I own a lot of Bitcoin, you need to understand the fundamentals of Bitcoin and what makes it so special. And it's so different from other cryptocurrencies, it's so different from stocks. Bitcoin cannot be confiscated if you hold your own keys. It cannot be censored. You can send your Bitcoin to anyone in the world. It cannot be devalued or inflated away. And this combination of permissionlessness, censorship, resistance, and the ability not to be inflated away or devalued through money printing makes it very, very valuable. Bitcoin also had this immaculate conception. The original founder disappeared from the scene. And so it's definitely the most decentralized of all cryptocurrencies and all assets. It's not perfect, but it's definitely the most decentralized. And it's really our only chance at having a neutral reserve asset. This is what makes Bitcoin very, very special. If you're going to own Bitcoin, though, don't trade it using leverage. Don't leave your Bitcoin on an exchange. If you leave your Bitcoin on an exchange, not your keys, not your coins, then you need the exchange's permission to send it to someone. So you're not using Bitcoin in a self-sovereign fashion. The other thing to keep in mind is we're at a period where the tide is going out. There's a lot of carnage. Tiger Global's blowing up. At least looks like it's blowing up. VC portfolios are blowing up. When the tide goes out, and this is the famous Warren Buffett quote, you can see who's been swimming naked. This is when you get companies blowing up. I remember very well when Enron blew up in 2000, 2001. WorldCom as well was another casualty of receding stock prices. I think this time around there's a possibility that we see more crypto failures. We could even see a stablecoin fail. So if you're holding Tether, USDT, or Terra USD, UST, these could break. Some of the algorithmic coins as well could break. And these are the times that test how anti-fragile the asset is that you're holding. Bitcoin, I don't think is going to break. It's incredibly robust and anti-fragile. But these weird concoctions that allow you to earn 10% on your money or whatever, you have to consider the possibility that stable coin might completely blow up and you might lose 40%. You're earning 10% interest income, but you lose 40% or 50% or 100% on the principal, and that can definitely kill your returns. So what's happening here is the markets seem to be playing chicken with the Fed, and selling off and just trying to force his hand. And it's a question of who is going to blink first. That these two cars are going high speed towards each other. I imagine that Powell is going to have to blink at a certain point, but it's probably when the VIX is much higher. It's when we start to see credit spreads widen a lot, when we begin to see possible junk bond defaults, and we get more credit risks manifesting themselves. Meanwhile, it's very important to keep an eye on Bitcoin's logarithmic chart. This is the only one that really matters. And it's important to realize that Bitcoin can go much higher, but it can do it in such a way that it really frustrates people. So if we go back, again, this is a logarithmic weekly chart. If we go back, we can see that Bitcoin peaked in November of 2013, and then it really was in nowhere, in no man's land for another call it 3 years, even 4 years. Something very similar happened after the 2017 peak. So we're currently really trading sideways in Bitcoin as measured against a dying reserve asset, which is the US dollar. And Bitcoin, for better or for worse in the short term, is correlated with risk assets. It's very susceptible to Fed policy on the surface of things. But lower Bitcoin prices means that you can buy more, you can hodl, and Bitcoin will eventually be revealed to be the true risk-free asset that it is, because it has the censorship-resistant quality, and it cannot be debased or devalued as well because of the fixed maximum supply of 21 million coins. So Bitcoin will move in such a way that when it goes up, you feel like you don't have enough, and when it goes down, all the people who wanted to buy in at 64,000 are now too scared to buy. It really plays with your head, and so it's very important not to use leverage, and also to just dollar cost average. I'm also using limit orders. I have limit orders in at 35,000, 30,000, 25,000, and 20,000 if we get a spike down, and I've talked about that for a while. I love this tweet from Sam Callahan that I want to finish with. When you're long Bitcoin, you're long central bank incompetence. I'm bullish. I think this is definitely something that we can bet on, the continued incompetence of the Fed. And it's not just that they're incompetent, though they certainly are. They're very arrogant as well. But the system is falling apart. If they try to raise interest rates, they blow up the risk asset market. If they turn the money printers back on, we have runaway inflation and possibly hyperinflation. So this is all going to end very badly. The best place to hide, in my opinion, is Bitcoin. There will be drawdowns. There'll be short-term correlation, possibly with tech stocks. When that correlation breaks, though, we are going to see the mother of all rallies. And we don't really know when Bitcoin will begin to be priced as the risk-free, pristine asset that it is. But you definitely don't want to be on the sidelines when that happens. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.